Now, a lot of people ask me, Eric, do you think now is the time to enter the equity markets? It's had a sell-off. Is now the time to get in? I warn you all, and I'm going to show you two reasons why right here. If you look at the first graph, S&P 500 profit margins, what do you see? Profit margins skyrocketed to all-time highs because all of a sudden inflation came in the system. When inflation first comes in and hits the price of goods, companies all of a sudden get all these demands, so they raise their prices up. The cost hasn't caught up, so all of a sudden profit margins just balloon for companies. That's exactly what happened. Usually profit margins run 4, 5, 6, 7%. We got profit margins up over 12%. Right now they're at 11.7. So a lot of people say, well, the S&P 500 forward earnings is at 17.4, a little higher than historical norm. But if profit margins fall by 20, 30, 40, 50%, well, what is this trading at? It's up in the mid to high 20s. And by the way, why are you putting a high PE multiple on declining forward earnings? So the big problem that I see with the equity markets today is we're going to see a big retrenchment in corporate earnings over the next 6-9 months as costs continue to grind higher and pricing power continues to decline. And therefore, I think we have more downside. I'll show you this really quickly, too. This is the Buffett indicator. This is way Warren Buffett determines whether the equity markets are overvalued or undervalued. The red line is GDP. And his basic theory is the total market capitalization of all stocks should largely track where GDP is. If it's under that, then the stock market is undervalued. If the market capitalization is above GDP, then it's overvalued. Well, look at the moonshot that we ended up having and how overvalued it is still compared to GDP even after the sell-off.